All right, my friends, I don't want to be a negative Nelly, like, oh, the world's falling apart, we're all gonna die by Putin or the Chinese or the globalists. I'm actually optimistic. I'm an optimistic guy, and the reason is because I look at the good book and I know how it ends. That God is always and everywhere good, and God always and everywhere will reign supreme as He does right now. Now, on this earth, unfortunately, we don't know. And as such, it's always nerve wracking to look into the future and say, it's easier to be negative than positive. That's why the fear mongering all over YouTube and the media, you're never going to be able to retire. It's stupid. With that said, you don't want to bury your head in the sand either and say, oh, it's all good and be Pollyannish. I mean, I think you got to look at both sides and make a deliberate decision on how you approach things. And it's one of I think about this stuff every day because look, I got a debt, I got a mortgage, man. You know what I'm saying? I got some money, I got some income, but those aren't enough to get me by if my portfolio drops 50% and my income falls. I'm in a world of hurt. You know what I'm saying? I got 4 kids, man. You should see my insurance bill just on the homeowners and auto insurance. It's nuts, USA. But anyway, so I looked at this one like, ugh, oh boy. All right, so anyway, I just got interrupted by Lottie McGee over here. Oh boy. Anyway, so for me, I'm like, all right, as long as I can keep plugging, I'm gonna be okay. But the concern is always, what happens if another 2008 just comes and hits you like a ton of bricks? Then you're in a world of hurt, man. So there's two completely different methodologies here in terms of me, because I'm still accumulating, I still have debt, versus many of you, which might be in the retirement mode or about to be. My nose itches. All right, so let's take a look at this chart. And as such, for me, there's nothing I can do. I mean, I can't do anything differently simply because I have to keep doing what I'm doing, which is hopefully continue to make some money, pay down bills, or debt, pay down debt, save. That's all I can do. There's nothing else, man. You know what I'm saying? I'm only 51 years old, for heaven's sake, but that might be different for you. And if it is, this is why I say you probably should think about downshifting. All right, so anyway, let's take a look. This is from Advisor Perspectives S&P Composite Index, all right, regression to trend, real inflation-adjusted price since 1871, and you can see it's logged. All right, so log means we start at 32, we double to 64. See that same, we'll just say that's an inch. We go from 64, we double to 128, that's an inch. 128 to 256, that's an inch. 256.5, you get it. All right, so here's a trend. That's the red right there. All right, that's the trend from 1871. And you can see the latest monthly average is 131% above trend, which is the highest it's ever been. Now, in of itself, that doesn't mean, oh my goodness, fall off a cliff. But that does concern me, I'm not going to lie. And we've been steadily above trend. Here's 2000 right there. So here's 1982, the depth of the market. Remember, you're getting stocks at a PE of 8 with a dividend yield of 6 or something like that. That's nuts. All right, so this is the best time to invest right here. Yeah. So if you invest like that, you can see that's Reagan, Paul Volcker. Everyone kisses Paul Volcker's butt. I don't get it. I mean, I get it, but it's just silly. And then we got till 2000. So you can see this massive accumulation of equity returns from 1982 to 2000. The big fall kind of ramped back up, then another big fall. Massive accumulation right here. It's sad for all the people who got out right here. They said, I can't take it. It's just sad, man. I get people every now and again email me, said, I've been out for 15 years. Don't tell me how much money I missed. I just need to know when to get back in. And they want to hire me. I'm like, nope, not touching that with a 10-foot pole, man. But anyway, you can see here's right here is the Great Depression. Right here is right after the war. You could not have picked a better time to invest than right after the war until 1966, and then it started going down here. 66 to 82, we've talked about it a million times. The worst time to be an investor if you're retired because high inflation and low rates of return on the markets. But what else are you going to do? Put it in bonds? You would have got smoked. And I'm going to do another video on that at some other point. But anyway, point being, now when I say smoked, you wouldn't have got smoked. Let me back up and say, not necessarily. It's just it's a tough time. This right here is a tough time to be an investor, especially right when you retire. But everyone had pensions back then, Josh. No big deal. No, they didn't. No, they did not. They did not have pensions. I go into that in my book, You Can Retire on Social Security. It's such a fallacy and it ticks me off. But so worst time to invest, best time to invest. Interesting, right? So worst time to invest, best time to invest, worst time to invest, best time to invest. Best time to invest, worst time to invest. Worst time to invest, best time to invest. Yeah. Here's a 1929. So this is after World War I, which was idiotic in the level of human just chaos that happened. So the 20s, oops, you see this. And here we are, man. The latest monthly average is 131% above trend. The peak in 2000 marked an unprecedented 129% above the trend, substantially higher than the 1929, which is 78% above trend. You can see below trend in 2009, we're only 24% below. 1982, we're 60% below. it's probably 32, we're 78% below. So basically, the worst time to be below was right here, 1929. And 1982, 1932, excuse me. 1932 was 67% below, right here, there we go. And it's 60% below. So 1932 is 67% below. 1982 was 60% below. And then in 2009, it was 24% below trend. And that's it. That's all. That's it. But now we're 131% above trend, and that's with right here, man. All right. The major, incidentally, standard deviation for prices above and well below trend is 44%. Yay. We can see that. All right, you can see all this. The peak in 2000 was well north of 3 standard deviations, and the peak in 2007 was around 2 standard deviations below the trend. So this is right here is what concerns me. You can see everything is pretty much within 2 standard deviations. We have 1 standard deviation below trend here in 1920, 1930s, 1940s, and the 1980s, from 1966 to 1982. But then look at this. We didn't even hit 3 standard deviations above trend in 2000. Yeah, that's scary. And now we're 4 standard deviations above trend. 4. I mean, that look at that. 4. I don't even know what 4 standard deviations is. I know that 3 standard deviations is a 99.8% probability of from the past in terms of the volatility around the mean, the average, but I don't even know what 4 is. 99.99. I have no idea. Let's see here. So we're 4 standard levels we've never seen before, and I'm like, I don't know what to make of that, man. That makes me scared. Not gonna lie. Again, I'm not doing anything differently because what am I gonna do? Invest all my money in bonds? I'm not gonna do that, man. I mean, at the end of the day, the 10-year Treasury is still only yielding less than 3%. For me, I'm not doing that. Now at the end of the day, I've already done my downshifting. I'm already heavy into Wellington. I did that. So normally I'm VTI or VTV or bust. I downshifted because I do think bonds have more upside over the next 1 to 3 years than I think a lot of people recognize. So it's almost like a market timing. Oh, hold me, say how, friggin' curse me. Oh, you market time. You can't do that. Yeah, I did. I said, look, I think bonds have more upside than a lot of people recognize. So I went to Wellington heavily. All right. Now I have no idea what that has done. I don't know. I try to make a decision. I go with it and be done with it. In my Roth, I'm still all in VDIGX. That's my dividend paying stocks from Vanguard, VDIGX. So my big account is Wellington. My Roth, which isn't my big account, but I got a little bit of money in there, is all in stocks, as most people's Roth should be. All right. So, and I'm just plugging every 2 weeks in VTI. Every 2 weeks, VTI. In my brokerage account. That's it, man. That's all I'm doing. All right, so I downshifted to Wellington. Little Pablo's over here ripen. Hold on a second. Give me some semblance of protection on my bigger account, my biggest account, my IRA. I downshifted into Wellington. I'm never going to touch my Roth, hopefully, and my brokerage account, I use that as almost like my accumulate, hopefully get some growth in there and pay down debt. And once I'm paid down debt, I won't touch that anymore. Hopefully, I mean, it's just literally contingent on how I can make money. I got to make money. You got to make money. Should you change that if you're in retirement? That's a $64,000 question, or a $64 billion question because of inflation. But I want to show you a counter narrative to what this article suggests. This guy Rex Chapman, he says, "I apologize if I misunderstood on something, but this analysis struck me as flawed." It seems to suggest that one can use values above or below trend to indicate whether future long-term returns are likely to be below or above average. And then he says some stuff, and I completely didn't understand it. And I actually, I went and I said, right here, I said, because I was like, I don't understand what you just said, man. I said, Rex, would you care to elaborate on your comment? I like to read the challenges, so to speak, to various articles as it provides balance, but I'm confused you why you said the problem is that the trend line uses data through August 2014. I didn't get that. And anyway, his rebuttal, and I'm not yelling at this guy. I didn't understand what he's saying, and maybe it's because I'm just a caveman. And then he says it seems to suggest that one could indicate whether long-term returns are likely to be above or below average. And then Dougie Short says, nowhere in the commentary does I suggest or imply that this historical perspective is predictive. I completely agree that. However, I think that's kind of a cop-out because we're basically saying here we are, here's a trend. The last time we're this high, this what happened. Look, this I don't know. No one knows. And going back to the article I used yesterday about we've only had 8 or 12, 10-year completely statistically relevant time frames. We don't have enough data sets to even imagine. We just don't. We don't have enough data sets to suggest anything. I'm just saying at the end of the day, and this is what I shared with this guy right here, we're above trend, A, and B, maybe one of the reasons we're above trend is what I'm going to share with you here. My man Eric here. And all right, and all these negative notes. I'm not a big fan. Let's see, right here. My man Eric says, to put some facts, the 1950 ratio of corporate after-tax earnings of national income is 7.2%. At the end of 2021, it was 12.1, and that's what Eric's argument is, that the companies are making more money relative to GDP. And I'm like, yeah, because GDP is so low. I get that. The average of after-tax versus pre-tax earnings in 1950 was 55%. In 2020, it's 87%. All right. And then he says in 1995, S&P earnings were 36% of corporate earnings. In 2021, it's 58%. All right. And then he gives a bunch of different things. I'm like, yeah, but and this is why I argue. I said, I don't disagree with you, but I could make the same argument against your interpretations that maybe the last 30 years were an anomaly, because we see right here, here's a trend in the last basically 30, literally probably since 1982, but we'll just say 30 years because he used that. We had extraordinary growth, extraordinary. And I say, man, it's an anomaly. Demographics are shrinking. The easy money in international trade and cheap labor is done. Interest rates are low, but it's not like they're way low historically. As I write this, right now, the 10-year treasury is at 2.91. Low, but not Japan-like low. On top of that, it seems the Davos crowd is intent on us going away from cheap energy via fossil fuels and nuclear. Cheap energy, cheap products. Expensive energy, it's going to be interesting. Last week, we can use any frame we want to paint any picture we want. The global warming, climate change fear. Weird how they always use 1979 as their starting point. Wonder why that is. Well, because that was around the time the global cooling scare began to wane. Carl Sagan, James Hansen did the rest. And now we're facing scarcity when it comes to energy. And no, I'm not just talking about electricity. I'm talking about energy, which makes the world go round. Anyway, then I said, I don't know. I'm not changing my investments. Already downshift. That's the best I can do. I'm just saying this does concern me, man. We're heavily above trend. You can make an argument it's a different market, as Eric does now, than it was 50 years ago. I get that, but that doesn't mean the next 50 years are going to be the same market. See what I'm saying? It's like the easy wins are behind us, in my opinion. I could be wrong. And again, I don't know what to make it. However, I'm retired. I'm telling you, it's downshift one, man. If you're normally all stocks, go into Wellington or something like that. Fidelity Balance Fund, I don't care. If you're normally Fidelity Balance Fund, maybe go 50-50. If you're normally 50-50, maybe go Wellesley at something like that. I just think downshifting is good because I still think at the end of the day, the bond market has a little bit more upside than people attribute to. They say, they're going to raise the rates. The bond's going to get crushed. I'm like, let's look historically. And bonds are easy, my friends, easy to measure because there is no capital appreciation or depreciation in bonds. I mean, for any given year there is, but bonds mature at par. That's simple. You get the coupon, you get the maturity at par. That's the maturity at par. No more, no less. So bonds are easy to gauge, if that makes sense. And if bonds been knocked around like they have been, they're all coming back to par, man. Anyway, so I'm I do get nervous by this, but what are you going to do? That's the ultimate thing is what are you going to do? And the answer is nothing. Just keep doing what you're doing, in my opinion. But it'd be silly to say, oh, you don't want to be Pollyannish, but you don't want to be these freaking Robert Key. Who's that guy? Who's that guy? The rich dad, poor dad guy. Everything's gonna come. I can't take that either. It's embarrassing. All right, love your thoughts. We'll see you.